It is actually kind of funny. Like when we talk about big tech or the cloud and artificial intelligence, we tend to use this language that makes it all sound completely, ethereal.
Right. Yeah, it sounds totally weightless.
Exactly. It is just magic. We think of invisible fiber optic networks and these pristine climate-controlled rooms, right? Just endless streams of digital code.
Yeah, the whole concept of the cloud, it just feels so clean and virtual.
It really is a brilliant piece of branding, honestly.
Well, he's genius. The word cloud conjures up this image of something soft and intangible, just, floating gently up there in the atmosphere.
Completely disconnected from the dirty physical realities on the ground.
Exactly. But I mean, the reality is that the cloud is incredibly heavy.
So heavy. It is massively physical.
Yeah, to keep that digital world running, you need astronomical amounts of concrete and steel and just vast tracts of land.
And most importantly, you need power. Like an insatiable, nonstop supply of raw, unadulterated electrical power.
Right. And here is where the narrative of the market is just completely fracturing right now.
Because suddenly the companies stepping up to supply that critical power, the ones holding the keys to the future of AI, they are not the sleek Silicon Valley startups that you might expect.
No, not at all. We are watching this fascinating collision of the old economy and the new economy right before our eyes.
And the old economy might actually have the upper hand here.
They really might.
Welcome to the Deep Dive. Today, we are bringing you a special Talk Tickers edition, and this one is tailored specifically for you, the retail investor.
Yeah, if you were tuning in, our mission by now.
Right. We take a magnifying glass to the corporate earnings calls that are moving the markets, and we basically strip out the dense Wall Street jargon.
We want to figure out what is actually going on under the hood.
Exactly. Our goal is to give you a clear, actionable perspective on the stocks that are in your portfolio or on your watch list. And today, we are tearing into Chevron's Q2 2026 earnings call, ticker symbol CVX.
And right off the bat, I really want to stress to you listening, this is not your typical run-of-the-mill oil and gas quarterly update.
No, definitely not.
If you just read the top-line summary in the financial press, you are going to miss a massive structural narrative shift that is happening inside this company.
Oh, absolutely. So here's the hook for you today. Yes, Chevron is doing what it has always done. They're pumping a record amount of oil out of the ground.
Right.
But the real surprise here, the absolute plot twist of this quarter, is how this legacy century-old energy giant is quietly maneuvering to become the critical battery for Microsoft's massive artificial intelligence ambitions.
It is the perfect case study in why you just have to look past the headline industry classifications.
Yeah.
Like if you just label Chevron as fossil fuels and ignore the underlying infrastructure they are building, you're missing a massive piece of the puzzle.
So we are going to map this out logically for you today so we can build the full picture. First, we are going to tear into the headline numbers.
Fun stuff.
Right, the raw financial performance. And we will define what those metrics actually mean for your personal brokerage account.
Because that is what really matters.
Exactly. Second, we are going to dive deep into the operational story driving those numbers. So how they are engineering more efficiency and permanently altering their cost structure.
And we will unpack every single detail of that massive AI power deal.
Yes, we definitely will. Then we will analyze management's future guidance, including how they are actively navigating some very complex real-world geopolitical bottlenecks right now.
And finally, we will wrap it all up with an opinionated bottom line on whether this is a bullish or bearish signal for the stock.
So let's just get right into the data, because the financial scale we are talking about today is genuinely difficult to wrap your head around.
It really is. The numbers are just staggering.
So let's start there with the headline numbers. I'm just going to lay these out because the sheer velocity of the cash generation here is wild.
Go for it.
So for the second quarter of 2026, Chevron reported earnings of $12.1 billion.
Which is massive.
Massive. That translates to $6.11 per share. And their cash flow from operations, when you exclude working capital, hit nearly $20 billion.
$20 billion in a single quarter.
Yeah. But here is the number that really jumps off the page to you. Adjusted free cash flow came in at $15.4 billion.
Wow.
And they used a massive chunk of that to reduce their total debt by over $8 billion in a single 90-day period.
That is just incredible capital discipline.
Right. That brings their net debt to cash flow down to a staggering 0.6 ratio.
Yeah, those are not just strong numbers. Those are fortress-level financial metrics.
Absolutely.
But we really need to translate some of this accounting language for the retail investor, because Wall Street loves to use terms like adjusted free cash flow and working capital as sort of these gatekeeping mechanisms.
Well, totally. They want to make it sound complicated.
Exactly. It makes the math sound much more intimidating than it actually is.
Please do translate that. Let's not assume everyone listening is a forensic accountant, right? What does adjusted free cash flow actually mean in practical terms for the person who is just holding 100 shares of CVX in their retirement account?
That is a great question.
Why should they care about that specific metric more than just, the top line revenue?
So top line revenue just tells you how much money came through the front door.
Okay.
It does not tell you how much of it the company actually gets to keep. Adjusted free cash flow is kind of the ultimate truth teller in corporate finance.
The truth teller. I like that.
Yeah, because it isn't an accounting trick, and it isn't some paper profit that relies on complex depreciation schedules or anything like that.
Right.
Think of it as the actual cold, hard cash left in the register at the very end of the quarter, after the company has paid for absolutely everything required to keep the business running and growing.
So after all the bills are paid.
Exactly.
Yeah.
They have paid all their tens of thousands of employees. They have paid the taxes. They have maintained the thousands of miles of pipelines. They have funded their new drilling projects for the future. And after doing all of that, they still have $15.4 billion in pure cash just sitting on the table.
Just sitting there. And what about the adjusted part?
The adjusted part just means they stripped out one-time unusual items that distort the picture right. So it gives you the true recurring cash-generating power of the underlying business.
Got it. And just to clarify, another term you mentioned when we say excluding working capital, we're basically just smoothing out the timing of when bills are paid and when checks are cashed, right?
That is the perfect way to look at it, yeah.
Like just normal business cycle stuff.
Exactly, because sometimes a customer owes you $1 billion on June 30th, but they don't actually pay until July 1st.
Ah, okay.
That swings the cash balance wildly from one quarter to the next, even though the fundamental business hasn't changed at all.
Makes sense.
So by excluding working capital, you're looking at the core cash generation engine and just ignoring the slight delays in the mail, so to speak.
Okay, so they have this massive pile of $15.4 billion in true unencumbered cash.
Yes.
For the shareholder listening right now, that cash on the table is the entire ballgame, isn't it? Because that is the pool of money management uses to actually reward them.
It is the only thing that matters in the long run. That free cash flow is what funds the dividend checks that get deposited into your account.
Right.
It is the money they use to buy back their own stock on the open market.
Yeah.
Which is huge because that reduces the total number of shares in existence.
So my shares become more valuable.
Instantly making the shares you own represent a larger, more valuable percentage of the company.
Wow. Okay.
And crucially, in this quarter, it is what they use to pay down that $8 billion in debt.
Which is just a crazy amount to pay off in 3 months.
When a company is generating that much free cash, they basically become completely sovereign.
Sovereign, that is a strong word.
But it is true. They aren't at the mercy of the credit markets or fluctuating interest rates because they are just funding themselves internally.
Man, I want to put that $20 billion in operating cash flow into perspective for you.
Please do.
Generating that much cash in 3 months is roughly equivalent to matching the entire annual gross domestic product of a small country.
Like an entire country's output.
Yeah, like Iceland or Senegal in 90 days.
It is staggering.
But I want to push back on this narrative just a little bit here.
Okay, lay it on me.
Because I see these massive numbers and my immediate skepticism kicks in,
Sure.
Is this just a lucky break? Are they just surfing a macroeconomic wave of really high commodity prices?
Right, the old oil price argument.
Yeah, because if the price of oil is artificially elevated due to global tensions or whatever, then any oil company can look like a genius.
That is very true.
So is the underlying Chevron machine actually running better than it was a year ago, or are they just cashing in on a tight oil market?
That is the exact right question to ask. And honestly, it is the ultimate crux of evaluating any commodity-based business.
Right. You have to separate the luck from the skill.
Saga.
You have to separate the macro environment from the operational execution. Obviously, favorable pricing helps the bottom line. No one is denying that.
Sure.
But these numbers are definitively not an accident of the market. The sheer volume of cash they are throwing off is the direct result of a structural shift in how the company operates.
A structural shift.
Yeah, we are seeing record-breaking production volumes colliding with absolutely ruthless internal cost-cutting. They're literally doing more with less capital.
Which perfectly sets up the transition to the operational story. Let's look at exactly how they are doing more with less.
Let's do it.
We will start by examining their production records and a concept that management kept repeating on the call, which was sweating the assets.
Sweating the assets, yeah.
So to give you the data, global production grew more than 5% quarter over quarter. In the U.S. upstream business, they hit an all-time record of nearly 2.1 million barrels of oil equivalent per day.
Massive.
And at the same time, their refining throughput, the downstream side of the business, hit over 1 million barrels per day.
Yeah.
Right.
And internationally, they hovered near 2 million barrels per day.
I actually want to stop you right there and clarify those terms for the listener, just to make sure we are all on the same page here.
Oh, sure.
You mentioned upstream and downstream.
Right. Let's not assume everyone knows the industry slang. Break those down for us.
So upstream refers to the exploration and production side of things.
Getting it out of the ground.
Exactly. It is the act of finding the oil or natural gas in the ground and physically pulling it up to the surface. It is the rugged resource extraction part of the business.
Right. The hard hats and the rigs.
Yep. And downstream refers to the refining and distribution side. So once you have the raw crude oil, you have to process it in a massive refinery to turn it into usable products like gasoline or jet fuel and diesel.
Okay.
Chevron is an integrated supermajor, meaning they do both. They pull it out of the ground and they refine it into the final product.
Okay, so they're hitting on all cylinders on both ends of the supply chain, basically. But I really want to focus on that international number you mentioned, specifically what is happening in Kazakhstan.
Yes, the Tengizchevroil operations.
Right, universally referred to as TCO on the call.
Correct. This is a massive joint venture operation in Kazakhstan that Chevron operates. And the numbers they reported here are just staggering.
Unbelievable numbers.
They added 170,000 barrels per day of production quarter over quarter.
Wait, 170,000 barrels a day of new, highly profitable production from just one concentrated area.
Just one area, yeah.
That is a massive jump in a very mature industry.
Yeah.
How exactly did they pull that off so quickly? Did they suddenly discover a massive new reservoir out there, or what?
No, and this is where the engineering gets so fascinating. It all comes down to a process called debottlenecking.
Debottlenecking, okay.
Yeah, during the earnings call, management detailed how they increased the capacity of their third-generation plant in Kazakhstan from 260,000 barrels per day up to 320,000 barrels per day. And they did this all during a scheduled turnaround in the fourth quarter of 2025.
Okay, we definitely need to unpack two things there. First, what is a turnaround in an industrial context? And second, what does debottlenecking actually look like in the real world?
Sure. So a turnaround is essentially a massive, highly choreographed maintenance period.
Okay.
Imagine you are driving a high-performance race car. You can't just drive it at top speed forever, right?
Yeah.
Eventually, you have to bring it into the pit stop to change the tires and check the engine and make repairs.
Right, you have to maintain it.
A turnaround is a planned shutdown of a massive industrial facility, like a refinery or a processing plant, so the engineers can get inside the equipment to clean it out, upgrade parts, and perform critical maintenance.
That sounds expensive.
It is incredibly expensive because while the plant is shut down, you are obviously not making any money.
Right, the oil isn't flowing. So they utilize this planned downtime to do the debottlenecking then.
Exactly. And debottlenecking is all about identifying the single choke point in a massive system and widening it.
Widening the choke point.
Yeah, imagine a 6-lane highway that suddenly narrows down to 2 lanes for a mile and then opens back up to 6 lanes.
That sounds like a traffic nightmare.
Right, and that 2-lane stretch dictates the speed of the entire highway.
Ah, I see.
In a chemical plant, oil and gas flow through a massive interconnected series of pipes and heaters and separation columns.
Okay.
Management realized that their main distillation column, which is a massive vertical tower where they separate the crude oil into different components using heat, that tower was the bottleneck.
So did they have to build an entirely new multi-billion-dollar distillation tower next to it to increase the capacity?
This is the brilliant part. No, they didn't.
Wait, really?
During the turnaround, they just opened up the existing column and simply swapped out the internals.
The internal.
Yeah, inside these massive towers, there are a series of specialized trays and packing materials that the oil and gas flow through as they heat up and condense.
Like a filter system almost.
Kind of, yeah. The Chevron engineering team designed new, highly advanced internal trays that allow the fluids to flow through much faster and separate more efficiently.
That is so smart.
It was a surgical, low-capital modification to the existing plumbing. By just changing the internal geometry of that one single column, they yielded an extra 60,000 barrels a day of overall plant capacity.
That is an unbelievable return on investment.
It really is.
They didn't pour new concrete or build a new facility or anything. They just optimized the fluid dynamics inside the steel they already owned.
It is the ultimate example of working smarter, not harder. And this ties directly into management's current overarching philosophy, which they refer to as sweating the assets.
Let's talk about that because this feels like a major psychological shift for the industry as a whole.
Oh, it is a massive departure from the past.
Yeah.
For the last decade, particularly during the early shale boom, the entire oil and gas industry was just obsessed with top-line production growth at any cost.
Right, the drill baby drill era.
Exactly. Executive compensation was tied to how many barrels they produced, not how much money they actually made.
Wow, that is a terrible incentive structure.
It was. They would drill everything in sight, borrow heavily, and spend massive amounts of capital just to show Wall Street a chart with a line going up and to the right.
But underneath that growth, they were burning cash, weren't they?
Absolutely. They weren't generating free cash flow for the shareholders at all.
It is kind of like running a marathon, but treating it like a sprint.
Yes, perfect analogy.
Like in the past, these companies were sprinting the first 5 miles, just burning through all their energy, taking on massive debt to drill more wells, and then collapsing when oil prices dipped. They were just exhausted and broke.
That is exactly what happened. But Chevron has explicitly pivoted away from that model now.
Okay.
They are prioritizing efficiency and return on capital over reckless growth. The CEO, Mike Wirth, specifically noted on the call that they are deliberately working at plateau to generate free cash flow.
Working at plateaus, which means they could easily grow their output in places like the Permian Basin if they really wanted to, right? Like they have the land and the rigs ready to go.
Oh, they definitely have the inventory.
But they are actively choosing to hold production relatively steady and just rake in the cash from their most efficient wells.
Precisely. They are leaving molecules of oil in the ground intentionally.
Intentionally. That is so counterintuitive for an oil company.
It is, but think about why. Because the cost of the steel casing and the sand and the pressure pumping required to extract those specific marginal molecules right now just doesn't meet their stringent double-digit return thresholds.
Ah, so it's a margin game now.
Exactly.
Yeah.
They only want to drill the most profitable barrels, not just any barrel.
Which brings us to the next critical piece of the operational story here. The efficiency and synergy wins.
Right.
Because producing a lot of oil is obviously only half the equation for a profitable company. What it fundamentally costs to produce that oil is the other half.
Crucial half.
And the data Chevron delivered here is wild. They achieved their $3 billion structural cost reduction target a full 6 months early.
And what is crucial for the retail investor to understand here is how they actually did it.
Right, because cost reductions can mean a lot of things.
Exactly. Wall Street is used to seeing cost reductions that are just thinly veiled mass layoffs.
Right. You fire 10,000 people to make the quarter look good.
You fire them, but the underlying business actually gets weaker. Chevron's cost reduction was entirely different.
How so?
70% of those $3 billion in savings came purely from efficiency gains and structural rewiring of how the company operates on a day-to-day basis.
I noticed the CFO, Amir Bonner, spent a significant amount of time talking about predictive maintenance and centralized engineering on the call.
Yes.
Let's translate that. In the past, it sounds like they had fragmented, highly localized teams, right? Like the engineers in Texas were doing things one way, and the engineers in North Dakota were doing things a completely different way in their own little silo.
Exactly. It was highly decentralized and deeply inefficient. Chevron reorganized to bring all their shale and tight assets, meaning their massive operations in the Permian Basin in Texas, the DJ Basin in Colorado, and the Bakken shale they just acquired from Hess, under one common centralized management structure.
Okay, just to pause you there for a second. When you say shale and tight assets, you were talking about unconventional oil extraction, right? Like fracking.
Correct. Unlike traditional oil reservoirs where you just drill a vertical hole and the oil flows up naturally, shale rock is incredibly dense. It's what they call tight.
Right. It doesn't want to let the oil go.
Exactly. You have to drill horizontally for miles and then use hydraulic fracturing. So pumping water and sand and chemicals at ultra-high pressure to crack the rock and force the oil out.
It sounds incredibly intense.
It is a highly complex manufacturing process that requires intense engineering precision.
So by centralizing the management of all these complex shale assets, what is the actual tangible benefit on the ground?
It is all about cross-pollination of best practices. If a drilling team in the Permian Basin figures out a slightly faster way to pull a drill string out of a well, or maybe a cheaper way to source sand, they don't just keep it to themselves anymore.
Right, they share the knowledge.
Exactly. That data is immediately analyzed centrally and pushed out to the teams operating in the Bakken and the DJ Basin. They standardize the most efficient processes across the entire global portfolio.
And speaking of the Bakken, we really have to talk about the Hess acquisition.
Oh yeah, that was huge.
Because they captured $1.5 billion in acquisition synergies, also 6 months ahead of schedule.
Right.
Not only that, but they captured 50% more synergies than they initially promised Wall Street when they first announced the merger.
It is incredibly impressive. When you buy a massive company like Hess, there is always overlapping corporate fat.
Sure, redundant departments and stuff.
Exactly. You don't need two separate accounting departments or two sets of proprietary software licenses or redundant supply chain contracts, right? Chevron came in, ruthlessly integrated the Hess assets into their centralized system and stripped out $1.5 billion of redundant costs far faster than anyone anticipated.
But the most staggering metric to me, just looking at the financial models, is what is happening right now in the Permian Basin.
Oh, the Permian numbers are insane.
Despite massive sticky inflation across the global economy over the last few years, Chevron reported they're spending 25% less capital per barrel of oil equivalent in the Permian compared to just last year.
You really have to stop and think about the magnitude of that number. 25% less.
It is wild.
While the rest of the industrial world is complaining about the rising cost of steel and labor and electricity, Chevron has somehow made themselves functionally immune to inflation in their most important, highest producing asset.
Functionally immune.
They drove their capital intensity down by a quarter in a 12-month window.
How is that physically possible, though? Did they just force their suppliers to cut prices, or what?
It is a combination of incredible engineering execution and massive scale.
Okay.
They are drilling much longer horizontal laterals, meaning they can drain more oil from a single vertical hole, reducing the number of costly surface pads they have to build.
So fewer holes, but longer reach.
Exactly. And they are drilling faster, which means they rent the expensive drilling rigs for fewer days per well.
Ah, that saves a ton of money.
And they are utilizing shared surface infrastructure, so they are piping water and gas efficiently across vast acreages rather than building bespoke systems for every single well.
So it is really the compounding effect of hundreds of tiny, hyper-optimized engineering decisions.
Exactly.
And that completely explains the massive cash flow. If the price of a barrel of oil stays perfectly flat year over year, but your underlying cost to extract that barrel drops by 25%.
Your profit margins absolutely explode.
It is a masterclass in capital discipline.
It really is. But for all the impressive engineering in the oil fields, we really need to talk about the plot twist of the quarter.
Yes, here is where it gets really interesting and honestly a bit mind-bending for a traditional oil investor. Totally. This was the most surprising revelation on the earnings call by far. It is an initiative they're calling Project Kilby.
Project Kilby.
Chevron has signed a 20-year take-or-pay power purchase agreement, a PPA with Microsoft, for 2.67 gigawatts of behind-the-meter electrical capacity in West Texas.
We need to unpack this carefully for the retail investor because this represents a massive paradigm shift in how we view energy companies.
Huge shift. This isn't just about selling oil anymore.
Not at all. Let's start with the basics. What is a PPA?
Right, break that down.
A power purchase agreement is a long-term legally binding contract where a major buyer of electricity, in this case Microsoft, agrees to buy power directly from a generator, which is Chevron, at a predetermined fixed price for a set duration.
Okay.
And 20 years is practically an eternity in the fast-moving tech world.
Right. 20 years locks them in across multiple economic cycles. And what does the take-or-pay provision mean in this specific context?
Take-or-pay is the ultimate security blanket for the company building the infrastructure.
Yeah.
It means Microsoft is legally obligated to pay Chevron for that massive amount of power generation capacity, whether they actually end up utilizing all of it or not.
Wait, really? So even if they don't use the power, they still pay?
Exactly. If Microsoft's AI ambitions slow down in year 5, and they don't need all the electricity, they still have to write the massive check to Chevron.
Wow.
This structure completely de-risks the multi-billion-dollar capital investment Chevron has to make to build the power generation facility in the first place.
That makes total sense.
Chevron gets guaranteed predictable cash flows regardless of how the tech market actually performs.
Okay, so that explains the financial structure perfectly, but the physical location is the really wild part to me. You mentioned this is behind the meter capacity.
Yes, behind the meter.
What does that actually mean, and why is it so critical to the whole AI boom?
To understand behind the meter, you have to understand the severe physical limitations of the current U.S. electrical grid, particularly in places like Texas.
The grid is struggling right now.
Massively. The grid was built over decades to support steady, predictable load growth from normal homes and commercial businesses.
Right.
It was absolutely not designed to handle the sudden, massive, highly concentrated power demands of hyperscale artificial intelligence data centers.
Because these data centers are essentially just giant, power-hungry warehouses filled with thousands of the most advanced silicon chips in the world, just running complex algorithms 24/7.
Exactly. A single modern AI data center can consume as much electricity as a medium-sized city.
That is terrifying.
If Microsoft tries to build one of these facilities in West Texas and just asks the local utility company to plug it into the public transmission grid, which is what we call in front of the meter, a few things happen.
Okay, what happened?
The local grid might literally collapse under the strain, causing brownouts for everyone else.
Right, the grid just can't handle it.
Second, the regulatory queue to get approval to connect a massive new load to the transmission grid can take 5 to 7 years.
7 years.
Yes, and in the AI arms race, a 7-year delay is a literal death sentence.
Okay, so behind the meter is the ultimate workaround then.
Precisely. Behind the meter means Chevron is building a massive multi-gigawatt natural gas power plant directly on the same physical piece of dirt as Microsoft's new data center.
Wow, so they're basically neighbors.
They are co-located.
Yeah.
The electricity flows straight out of Chevron's gas turbines across a specialized private connection and directly into Microsoft's server.
Completely off the grid.
It bypasses the highly regulated, painfully slow, and overburdened public utility grid entirely.
So if I'm an investor looking at Chevron, I have to ask, what does this mean for their core identity?
Right.
Are they pivoting to become an electric utility company now? Because historically, oil companies stick to extracting molecules and utility companies stick to generating electrons.
What is so fascinating here is that Chevron's management has realized they hold a completely unique hand of cards that the tech monopolies desperately need right now. Microsoft, Amazon, and Google are currently constrained by one major thing: reliable baseload power.
And baseload is the key word there, right? Because we hear a lot about tech companies buying solar and wind power to meet their green energy goals.
Right.
Why can't Microsoft just build a giant solar farm in the Texas desert to power this AI center?
Because solar and wind are what the industry calls intermittent power sources.
Well, they come and go.
They are fantastic when the sun is shining brightly and the wind is blowing steadily, but the sun sets every single evening and the wind dies down.
And the data center can't just go to sleep.
Exactly. You cannot run an AI data center on an intermittent schedule. The server rags cannot power down at night. They have to run complex training models continuously 24 hours a day, 365 days a year.
So they need a constant flow.
They require base load power, a massive, unbreakable foundation of constant electricity. And honestly, the only ways to generate reliable base load power at that scale are nuclear, coal, or natural gas.
And Chevron happens to sit on a literal ocean of natural gas right underneath the Permian Basin in West Texas.
Exactly. Think about the synergies here. Chevron already owns the surface land.
Right.
They own the mineral rights to the massive reserves of natural gas directly underneath that land.
Okay.
They have decades of experience managing complex, multi-billion-dollar capital projects in really harsh environments.
Yeah, they know how to build big things.
And perhaps most importantly right now, they have deep pre-existing supply chain relationships with turbine manufacturers like GE Vernova.
Which is huge because those turbines are hard to get.
Oh, they are back-ordered for years if you're a new entrant trying to buy one today.
Yeah.
But Chevron can actually procure the heavy generation equipment.
It really is a perfect marriage of necessity then.
It really is.
Microsoft gets the guaranteed immediate reliable baseload power they absolutely must have to win the AI arms race against Google and Meta.
Yeah.
And in exchange, Chevron gets a 20-year guaranteed contracted cash flow stream that is completely decoupled from the violent cyclicality of global oil prices.
Completely decoupled.
Management noted on the call that this project will deliver mid-teens returns on capital.
Mid-teens.
That is an incredibly stable, high-margin, utility-like revenue stream injected straight into a traditional oil company's balance sheet.
And here is the kicker on all this.
Oh, there is more.
Worth emphasized that Project Kilby is not a one-off experiment. It is a highly repeatable business model.
Wow, so they are going to do this again?
They are already in advanced discussions for additional behind-the-meter opportunities with other hyperscalers.
That is wild.
This provides a massive high-growth vector for Chevron that most retail investors, and frankly a lot of Wall Street analysts, simply haven't priced into the stock yet. They still just look at CVX and see an oil company.
Which is exactly why you have to read the actual earnings call transcripts. Okay, we need to keep moving through the operational story, though. Let's look at the chemistry and refining side of the business, because they aren't just selling crude oil and electricity, right?
Right.
They are deeply involved in the complex petrochemical supply chain. And on the call, we saw surprisingly strong financial performance from CP Chem, which is their massive joint venture in petrochemicals.
Yeah, to understand why CP Chem is outperforming, you really have to pull back and look at the global geopolitical and logistical map right now.
Okay, zoom out.
There are severe ongoing disruptions in the Middle East. Geopolitical conflicts are severely restricting maritime shipping routes, particularly through the Strait of Hormuz and the Red Sea.
Right. We've all seen the news about the ships being attacked.
Exactly. Oil tankers and chemical carriers are being forced to take massive, costly detours all the way around the Horn of Africa just to reach Europe and Asia.
And how does that logistical nightmare translate into a financial advantage for a company based in the United States?
It comes down to the raw materials used to make chemicals. These global disruptions have severely tightened the supply and spiked the price of middle distillates and naphtha.
Let's define those terms really quick. What is a middle distillate and what exactly is naphtha?
So when you put raw crude oil into a refinery and heat it up, it separates into different layers based on boiling points.
Okay.
The very heavy stuff at the bottom becomes asphalt. The very light stuff at the top becomes gases. The layers in the middle distillates, are things like diesel fuel and jet fuel.
Makes sense.
Naphtha is a highly volatile, flammable liquid hydrocarbon mixture that sits right between the light gases and the heavier fuels.
Okay, and why is naphtha so important?
It is incredibly important because over in Asia and Europe, the vast majority of massive petrochemical plants use naphtha as their primary raw ingredient.
Oh, okay.
They run the naphtha through a massive superheated cracker facility to break the molecular bonds and create basic building blocks like ethylene.
Which goes into everything, right?
Literally everything. Plastics, synthetic rubbers, basically everything in the modern physical world.
But because of the shipping constraints in the Red Sea, getting that naphtha out of the Middle East and over to the chemical plants in Asia and Europe is currently very difficult and extremely expensive.
Precisely. The international chemical producers are just being squeezed by exorbitant input costs right now.
Okay, so how does Chevron win here?
Well, Chevron's CP Chem joint venture operates primarily right here in North America, and they do not use naphtha as their primary raw ingredient.
Oh, what do they use?
They use ethane.
And ethane is a byproduct of natural gas extraction, right? Which Chevron is already producing in massive quantities in places like the Permian Basin.
Exactly. Because of the ongoing shale boom, the United States is absolutely swimming in cheap, domestically produced ethane.
Wow.
So while Chevron's global competitors overseas are struggling with highly inflated input costs for naphtha due to maritime conflicts,
Chevron is just sitting in Texas, cracking cheap, abundant, locally sourced ethane into highly profitable polyethylene.
it is a massive structural margin advantage. The global supply chain disruption is effectively acting as a massive tailwind for their domestic chemical operations.
It is a perfect example of why having a diversified, globally integrated asset base is so critical.
So critical.
Like a geopolitical crisis that crushes a specialized European chemical manufacturer ends up being a profit driver for Chevron's CP Chem division.
Exactly. It buffers the whole portfolio.
There was one other fascinating detail buried in the operations update about technology licensing that I want to hit.
Oh, the surfactant.
Yes, management mentioned they are licensing out their proprietary ZEL surfactant technology.
This is so cool.
First, what on earth is a surfactant, and why is this specific technology so important that they highlighted it on a major earnings call?
Okay, this gets into the microscopic physics of oil extraction, and it is genuinely fascinating. We talked earlier about shale rock in the Permian Basin, right?
Right, the tight rock.
Most people picture an oil reservoir like a giant underground cave filled with a lake of black liquid.
Yeah, that is exactly how I pictured it, honestly.
That's totally wrong.
Right.
It's more like a dense, heavy sponge made of solid rock. The oil is trapped inside millions of microscopic pores within that rock.
Right.
When an oil company fracks, they fracture the rock to create pathways, but a massive amount of the oil refuses to flow out because of surface tension.
Surface tension, like how water sticks to glass.
Exactly. The oil physically clings to the rock at a molecular level. It's the same physics that makes water beat up on a freshly waxed car.
Oh, wow. Okay.
Currently, despite all the advanced technology we have, the industry leaves about 90% of the oil on the ground.
Wait, 90% is left behind?
Yes.
I think most people assume when an oil well is empty, the oil is actually gone.
No, it's just that the easy 10% has been recovered and the remaining 90% is trapped too tightly to be economically viable with standard pressure.
That is mind-blowing.
So any technology that can change that physical dynamic and increase that baseline recovery rate by even 1 or 2 percentage points is worth billions and billions of dollars across a portfolio the size of Chevron's.
And that is where the surfactant comes in.
Yes.
Yeah.
A surfactant is essentially a highly specialized, incredibly complex chemical compound. Think of it as a high-tech industrial strength dish soap.
Dish soap.
Yeah. If you have a pan coated in heavy grease, you can run water over it all day and the grease won't move because of surface tension.
Right. It just repels the water.
But the moment you add a single drop of dish soap, which is a surfactant, it immediately alters the surface tension, breaks the bonds, and the grease washes away.
Ah, I see where this is going.
Chevron's ZEL surfactant is pumped down into the shale wells along with fracking fluid.
Yeah.
It interacts with the rock at a molecular level, radically lowering the surface tension and allowing a significantly higher percentage of the trapped oil to detach from the rock pores and flow freely to the surface.
That is just brilliant chemistry. But I have a question here. If they invented this magic chemical that increases their oil production by that much, why are they licensing it to another company?
That is the big question.
Why wouldn't they hoard that intellectual property and keep the massive advantage strictly to themselves?
It comes down to manufacturing scale and recognizing your own core competencies. Chevron is an energy company. They are not a specialty chemical mass manufacturer.
Right. They don't run chemical factories like that.
Exactly. They developed the formula for this incredible ZEL surfactant in their labs, but to actually pump it into thousands of wells across the Permian Basin, they need millions of gallons of it produced rapidly and consistently.
And they can't do that themselves.
If they tried to build the boutique chemical manufacturing facilities themselves, it would take years and billions of dollars in new capital expenditures.
I see. So instead of hoarding the recipe, they licensed the intellectual property to a massive established specialty chemical partner with vast existing manufacturing and distribution capabilities.
Exactly. Chevron realized that the real money isn't in collecting a small licensing royalty fee on a chemical patent.
Right.
The real money is in getting millions of gallons of this chemical produced at scale as fast as possible so they can pump it into their own massive acreage position in the Permian and instantly boost their recovery rates.
It's like inventing a revolutionary new shovel design during the height of a gold rush.
Well, that is a good one.
But instead of keeping the design a secret and trying to carve one shovel at a time by hand in your garage, you give the blueprints to a massive factory.
Yes.
They produce millions of them for you instantly, so you can equip your entire workforce and dig up your massive plot of land before anyone else can even react.
That is a brilliant analogy. It accelerates the scaling of the technology by an order of magnitude. They are leveraging a partner's manufacturing infrastructure to rapidly monetize their own underground assets.
All right, we have covered the massive cash generation and the brilliant engineering and operational shifts driving those numbers. Now let's pivot and look forward.
Let's do it.
It is time for management's future guidance. What are they telling Wall Street and the retail investor to expect over the next few years?
Some really strong signals here.
Let's start with their near-term capital discipline, because this stuck out to me as a massive positive signal. Management explicitly stated that they expect their 2026 organic capital expenditures, meaning the money they spend on drilling and maintenance and new projects, to finish at the absolute lower end of their previously announced $18 to $19 billion guidance range.
If you are a retail investor holding this stock, this is exactly the kind of boring, disciplined language you want to hear on an earnings call.
Boring is good sometimes.
Boring is very good. The management team is essentially looking the market in the eye and saying, we are finding ways to hit all of our aggressive production targets. We are successfully growing the business, but it's fundamentally costing us less money than we initially budgeted.
Because they are spending less, that extra cash doesn't get squandered on marginal projects just to use up a budget.
No, it doesn't.
It just drops straight down to the bottom line as free cash flow.
Precisely. It leaves hundreds of millions of unexpected dollars available for dividends and share repurchases.
Amazing.
It proves that their cultural shift toward value over growth is a tangible reality, not just a slick marketing slogan for an investor presentation. They are demonstrating severe financial restraint in an environment where they could easily justify spending way more.
And looking further out to their long-term 2030 objectives, they reaffirmed 3 highly specific, aggressive targets.
Yes.
They are aiming for 2 to 3% annual production growth, greater than 10% annual free cash flow growth, and a 3% absolute improvement in their return on capital employed, or ROCE.
Right.
But the real kicker here is the caveat management added. They plan to hit these growth metrics even at flat commodity prices.
That caveat is the most critical piece of information in the entire earnings presentation. Absolutely. Any junior energy exploration company can artificially grow their free cash flow if they get lucky, and the global price of crude oil skyrockets to $120 a barrel due to a sudden supply shock.
Right, that is just riding the wave.
That isn't skill. That is just surfing the macro wave. But Chevron is explicitly guiding for 10% annual free cash flow compounding growth, even if the price of a barrel of oil stays exactly where it is today for the next 4 years.
And how can they possibly guarantee double-digit cash flow growth if their core product doesn't increase in price?
Through the compounding effects of the structural cost reductions and efficiency gains we just spent the last 20 minutes unpacking.
It all ties together.
Exactly. By utilizing predictive maintenance, centralizing their engineering teams, deploying advanced surfactant technology, and reducing their Permian capital intensity by 25%, they are permanently lowering their baseline break-even costs.
So the margin gets wider.
Yes, if your revenue stays flat, but you continually engineer your extraction costs lower and lower, your profit margin expands mathematically, regardless of what the macroeconomic environment is doing.
You also mentioned ROCE, return on capital employed. Let's define that clearly, because you said earlier it was the ultimate measure of efficiency.
Return on capital employed is arguably the most important metric for evaluating a heavy industry company's management team.
Okay, how does it work?
ROCE tracks exactly how well a company generates pure profit from the total capital, both debt and equity, that it puts to work.
Right.
So if you give a CEO $1 billion, how much profit can they generate with it? Does it yield a 5% return or a 15% return?
Okay, I get it.
Chevron targeting a 3% structural improvement in their ROCE sounds like a tiny incremental number to a layman.
Yeah, 3% doesn't sound huge.
But for a global supermajor with hundreds of billions of dollars in assets moving the ROCE needle by 300 basis points is a monumental tectonic shift in underlying profitability. It means every single dollar they spend is working significantly harder than it was 5 years ago.
Now, we cannot responsibly analyze a global energy supermajor without addressing the geopolitical risks.
No, you really have to look at the map.
It is a massive, unavoidable part of the global energy landscape. And to be perfectly clear to you, the listener, we're looking at these issues strictly through the objective lens of how Chevron's management is navigating the operational and logistical realities on the ground.
Exactly. We are strictly analyzing the facts presented in the earnings call regarding supply chains and infrastructure.
And one of the most pressing questions from the Wall Street analysts during the Q&A portion of the call was regarding the status of the CPC pipeline, which runs directly through the highly volatile Black Sea region.
Right, the Caspian Pipeline Consortium.
And this specific pipeline is absolutely crucial, isn't it? Because it is the primary artery for evacuating all that massive new Tengiz production out of Kazakhstan that we talked about earlier.
It's the main exit route, yes.
With the ongoing severe regional conflicts involving Russia and Ukraine, there has obviously been massive concern about potential disruptions or sabotage or collateral damage to this critical infrastructure.
It is a highly sensitive operational choke point. There's no denying that. The CEO, Mike Wirth, had to provide a very clear, sober update to alleviate market fears.
What did he say?
He acknowledged that there have been intermittent minor impacts stemming from the broader conflict over the last few quarters. However, he confirmed that the pipeline is currently flowing at required capacities.
Okay, that is good news.
The operational mechanics rely on single-point moorings, or SPMs, located at the marine terminal in Novorossiysk, Russia.
Just to clarify, an SPM is essentially a massive floating offshore buoy anchored to the seabed that allows massive oil supertankers to hook up and load crude oil directly from the undersea pipeline without having to dock at a traditional shallow water port facility.
That is a perfect description, yeah.
Yeah.
Wirth confirmed that 2 of their 3 SPMs are currently fully in service and actively loading tankers.
And the third one?
The third SPM is just undergoing scheduled maintenance and refurbishments and will be back online shortly in the third quarter, restoring full redundancy to the terminal.
But given the volatility of the region, they aren't just crossing their fingers, relying solely on this one terminal in a conflict zone and hoping for the best, are they?
No way.
That seems like an unacceptable level of risk for a major corporation.
Absolutely not. This is where high-level corporate risk mitigation comes into play. Wirth outlined their extensive established alternative evacuation routes.
Okay, what are the backups?
If the CPC pipeline or the Novorossiysk terminal faces an extended catastrophic disruption, Chevron is not entirely paralyzed. They have already established and fully tested secondary routes to physically ship the crude oil on smaller vessels directly across the Caspian Sea to alternative pipeline networks.
Smart.
They have robust heavy rail options secured to move the product overland across the continent.
Okay, rail too.
And they have secured localized mass storage facilities to act as a massive buffer, allowing them to continue producing oil and storing it safely during temporary logistical shocks without having to immediately shut down the physical wells in Kazakhstan.
So it's a highly delicate fluid situation, but they have mapped out the contingencies. They aren't flying blind out there.
Furthermore, Wirth pointed out a broader geopolitical reality. It is in the vital vested economic interest of multiple powerful global governments across varying political spectrums to ensure that the CPC pipeline remains operational.
Right, everyone needs the oil.
The global economy desperately needs that massive, reliable flow of energy supply to prevent crippling price spikes.
Which actually leads us perfectly into the final piece of the operational puzzle here, the future growth catalysts.
Yeah, they have a lot of options.
Because if one specific geopolitical region gets too shaky, or the regulatory environment becomes hostile, Chevron has an incredibly deep bench of operational optionality scattered across the globe. They aren't a one-trick pony.
They really highlighted several unique special situations where they are advancing complex negotiations to unlock massive future resources in varied regulatory environments.
Let's hit a few of these global hotspots really quick. First, Iraq. Management noted that Chevron is nearing an official entry to become the primary operator of the West Qurna 2 and Nasiriyah fields.
The scale of West Qurna 2 cannot be overstated. It is one of the absolute largest conventional oil fields ever discovered on the planet, with recoverable potential well into the tens of billions of barrels.
Tens of billions.
Another major global operator, Lukoil, recently made the strategic decision to step away from the project, and Chevron is aggressively stepping in to fill that vacuum.
Okay.
They are currently negotiating a completely new form of operating contract with the Iraqi government. Management stated this new framework is expected to be highly competitive within Chevron's global portfolio, ensuring they aren't taking on the risk without a guaranteed massive upside.
Then there is the situation in Venezuela, which is equally complex, but moving in a positive direction financially for the company. Management noted that they are on track to fully recover their massive historical legacy debt from the country by early 2027.
Getting paid back?
Exactly.
Yeah.
And while operating strictly under the current authorized framework, They are rapidly growing their joint venture production. They have taken it from roughly 40,000 barrels a day just a few years ago to an expected massive 280,000 barrels a day by the end of 2028.
It demonstrates their ability to navigate highly complex, shifting sanctions environments and slowly, methodically rebuild physical production in areas where other companies have simply given up and written off their assets.
And finally, Argentina. This is a fascinating development that highlights the importance of national economic policy on global corporate investment.
Oh yeah, the RICH framework.
Right. Argentina has recently implemented something called the RICH framework, which extends significant new incentives directly to the heavy oil and gas sector.
The RICH framework is an absolute game changer for capital allocation.
Break that down. What does that framework actually give a company like Chevron? Why does a massive corporation care about a new regulatory acronym?
When a company like Chevron decides to develop a massive new shale basin in a foreign country, they are committing to spending billions and billions of dollars in upfront capital over a period of many years before they see a single dime of profit.
Right. It is a huge upfront bet.
The biggest risk they face isn't geological, it's political. Yeah. What if they spend $5 billion building the infrastructure and then a new government comes into power and suddenly doubles the corporate tax rate or changes the export tariffs, completely destroying the financial model of the project?
Right. The sovereign risk is massive.
A RICH framework solves that. It provides foreign investors with a legally binding 30-year guarantee of absolute fiscal and regulatory stability.
30 years, that is huge.
It locks in the current tax rates, export rules, and tariffs for 3 decades. Furthermore, it provides highly favorable terms like accelerated depreciation, which allows Chevron to write off the massive costs of their physical equipment, the rigs, the pipes, the processing plants, against their taxes much faster.
Which improves the near-term cash flow profile of the project.
Significantly, yes.
So they have extreme financial certainty.
Exactly. Chevron has formally applied for this framework for their massive El Trapial asset located in the Vaca Muerta shale.
Vaca Muerta is famous, right?
Vaca Muerta is geologically considered one of the most prolific, high-quality shale basins on Earth outside of the U.S. Permian. With this 30-year stability locked in, massive multi-decade capital investments become far more viable, giving Chevron the confidence to potentially triple their production in Argentina by 2035 without fear of arbitrary government interference.
Looking at all of this together, it really reminds me of the core strategy behind building a globally diversified mutual fund for a retirement account.
That is exactly what it is.
If you are a retail investor and you are heavily concentrated in just one single tech stock or one narrow sector, a single piece of bad news, a bad earnings report, or a regulatory shift can completely wipe out your portfolio.
Right, you are totally exposed.
But a well-managed mutual fund spreads that risk. Chevron is operating exactly like a diversified global energy fund.
Yes, they are.
They have massive, highly flexible levers to pull in the U.S. Permian Basin. They have the ultra-deepwater engineering marvels in the Gulf of Mexico. They have the massive conventional mega projects in Kazakhstan.
Right.
They have the geopolitical upside in Iraq, the recovery story in Venezuela, the rapidly expanding shale operations in Argentina under the new RIGI framework, and their massive offshore discoveries in Guyana.
It is an incredible portfolio.
If taxes go up in one country or a pipeline is temporarily disrupted in another, they don't panic. They simply allocate their flexible capital budget to whichever region on the globe offers the highest structural return with the most operational stability at any given moment.
That is the ultimate, undeniable structural advantage of being an integrated global supermajor. Smaller regional energy producers simply do not have that luxury.
They can't pivot like that.
Chevron has the massive balance sheet, the deep engineering expertise, and the vast geographic footprint to continuously optimize their portfolio on a global scale.
Okay. We have covered an immense amount of ground today.
We really have.
We started with the staggering cash generation numbers. We unpacked the deep operational story, the debottlenecking, the massive Hess acquisition synergies, the 25% reduction in capital intensity in the Permian, the brilliant surfactant chemistry, and the absolute plot twist of the Microsoft AI power deal.
Project Kilby, yeah.
We've analyzed management's future guidance and how they are navigating the geopolitical tightropes in Kazakhstan, Iraq, and Argentina. It is time for our bottom line.
The verdict.
We promised you, the retail investor tuning into Talk Tickers, a clear, actionable verdict on Chevron's Q2 2026 earnings. So I am putting you on the spot as the expert today.
All right, I am ready.
What is the definitive takeaway here? Looking at the totality of this massive global operation, are you delivering a bullish or bearish signal?
Based on the raw financial data, the structural engineering improvements, and the strategic positioning presented in this quarter, this is a fiercely, undeniably bullish signal.
Give me the deep why. Synthesize this complex, multi-layered thesis for the listener who's trying to decide what to actually do with their capital.
The core thesis is that Chevron is definitively proving their new operational model of value over growth.
Value over growth.
They are not just promising efficiency in glossy PowerPoint presentations. They are relentlessly executing it in the field. They are producing record all-time high amounts of energy globally while simultaneously crushing their structural multi-billion-dollar cost-cutting targets a full 6 months early.
Incredible execution.
They are utilizing centralized engineering and advanced technology to drive down the underlying capital intensity of their premier flagship asset in the Permian Basin by an astonishing 25% in a single year.
Despite inflation.
Despite inflation. And most importantly, they're taking the resulting massive $15.4 billion pile of free cash flow and using it to fortify their balance sheet, paying off $8 billion in debt in a single quarter, rather than blowing it on reckless low-margin drilling campaigns.
So let's make this highly actionable right now. What is the specific advice for the listener who already holds a position in CVX in their portfolio?
For the current shareholder, this is the definition of a fortress investment.
Fortress.
With a net debt ratio slashed down to 0.6 and a global break-even cost structure that is dropping rapidly due to structural efficiencies, this company is built with extreme durability.
Built to last.
It is designed to survive and thrive regardless of what the unpredictable macroeconomic environment or global commodities market throws at it over the next decade. They are generating so much free cash flow that they are going to pay you handsomely in consistent dividends and massive share buybacks to comfortably wait out any potential short-term commodity cycle downturns.
And for the listener who doesn't currently own the stock but is watching the market, looking for a place to deploy new capital and considering buying in?
For the potential buyer, you really have to realize that this is no longer just a traditional, straightforward oil and gas play.
Right.
It has evolved into a highly compelling dual play. Yes, you get the incredible resilience, the global diversification, and the massive cash flow of a legacy energy supermajor.
Yeah.
But through initiatives like Project Kilby, you are also getting a backdoor stable cash flow infrastructure play directly tied into the explosive artificial intelligence boom.
Which is wild.
They are actively transforming their vast dormant natural gas resources in Texas into 20-year guaranteed utility-like contracts serving the most powerful tech monopolies on Earth.
Which brings us beautifully right back to where we started our conversation today.
Full circle.
The grand illusion of the modern tech world is that the cloud is floating invisibly in the sky, but it isn't.
Not even close.
It is heavily anchored to the dusty ground in West Texas, relying entirely on the raw physical power generated by natural gas and massive heavy-duty turbines managed by a century-old oil supermajor.
It completely flips the script on the prevailing market narrative regarding who the ultimate long-term winners of the AI revolution might actually be.
Right.
It's not just the companies designing the software algorithms. It's the companies that control the physical baseline infrastructure required to run those algorithms.
And that is the final provocative thought I want to leave you with today to mull over as you review your own portfolio.
Yeah, this is a big one.
If a traditional legacy oil supermajor like Chevron can seamlessly step in, utilize their existing land and mineral rights, and suddenly become a multi-gigawatt tech utility provider powering Microsoft's cutting-edge data centers.
What else is out there?
Exactly. What other hidden, deeply valuable tech infrastructure assets are currently staring dormant, completely unpriced by the market inside the massive portfolios of old economy and industrial companies just waiting for the right moment to be monetized?
The physical constraints of the limitless digital world are just starting to show their cracks. Finding the legacy physical world companies that quietly own the solutions to those digital constraints is exactly where the real alpha is going to be generated over the next decade.
That is definitely something to think about the next time you ask an AI chatbot a complex question and briefly wonder where the massive surge of electricity required to generate that answer actually came from. Thank you for joining us on this special Talk Tickers edition of The Deep Dive. Keep digging into those earnings reports. Keep doing your own rigorous research. Stay curious about how the world actually works, and we will catch you on the next one.